Good morning. It is Wednesday, July 12th. Today we'll be talking about probabilities a little bit more, and we'll talk about portfolio diversification a little bit more in relation to liquidity. And we'll be talking about our position in crude oil, which is doing horribly right now. This is live futures trading with Hur Fund. I'm Arthur Hur. Okay, let's get into things. I want to try to keep these a little bit shorter than I've been making them. I know I've been going past 30 minutes for some of these. It's only my fourth one. Hopefully I will get better over time. Hopefully this is better than the first one. We'll see how it goes. We put on a straddle in crude oil. The only thing that's happened to crude since we put the straddle on is it's gone higher. We had a little bit of a reprieve, and then it's just been marching higher. I mean, it was up almost 2.5% on Friday. Yesterday it was up almost 3%, and today it's up almost 1.5%. I mean, it's annoying. I don't like it, but that's trading, right? It's you put yourself in a position to potentially be profitable, and it's not working out. It hasn't worked out yet. We had some pretty decent looking, the start of something nice yesterday morning, but after I closed out the live stream, crude just went higher. All the gains turned into losses, and now those losses have continued to magnify today. It's not terrible, but it's not great either. Let's go to this platform. So right now we are at a little north of 255 in terms of losses. Let's look at what our position is doing and saying. I figured out also, by the way, I mean, I'm still working things out. Yesterday I realized that all of my quotes were on a 20-minute delay on this platform, so I figured that out, and I got some of my old settings back. I got delta and extrinsic value and volume and open interest and everything open right now, and I figured out how to get the numbers to go up when they're higher, right? You just hit this little caret. So here's our position. Here's where we want crude to be at. Right now it's higher, right? Our threshold of pain is at we sold it for 643, so let's just round down so that we adjust earlier than than locking in a loss. But our threshold for pain is $6 higher, 78.50. If it gets to 78.50, we will adjust our trade and hedge it. When you hedge something, this is continuing what I was saying yesterday. When you put on a defined risk trade, you're hedging at the start. You're pretty much kneecapping yourself before you even enter the trade, before you stand to benefit or gain anything. I mean, I guess you can benefit from being correct, but you're not really. Your risk reward is just not really. There's not much there, and I don't think that you can really have outsized returns by hedging yourself at order entry. Doesn't make sense to me. I'd like to put a position on, if I'm correct, I benefit the maximum amount from that. And if it starts going against me, that's when you hedge, right? Because our assumptions didn't work out. And I guess some inflation data came out today. It's interesting, because they say oh, inflation is cooling, but yet you look at asset prices and they're inflating. So I mean, what are you supposed to go off of, right? There's no real way to know anything, and you can always second guess yourself and think many orders of magnitude in. But all you will end up doing is just winding yourself up, and being down 250, 200 right now. I mean, it's not great, but it's not the end of the world. We're gonna let the numbers play out. It's only day 4, so in any case, as I was I'll just run through some of my like inner psychology and thoughts like when I go through losses. You know, like I'm like, okay, well, it was trading. I did everything right as far as just the mechanics that I wanted to do. 7250 straddle, wanted to stay there. The only thing that happened to it was it went higher. So I'm like, oh man, it just looks like it just wants to break through like 74, and it just looks like it's on a mission to 75. I should have sold the 75 straddle. I should have sold the 75 straddle. Of course, it's like so obvious in hindsight. Whereas like probably the day before I put it on, I was like, oh, maybe I should have sold the 70. Well, if I sold the 70, I would have been in that much more pain. But yeah, it's like, what if you sold the 75 and it went down to 70? What if, if you thought it was going to go to 75, why didn't you just buy it? Why didn't you just buy the underlying? You know, like there's so many, and if you just bought the underlying, what if it went straight down? You know, I mean, there's too many of these what ifs, and instead of trying to entertain all of these like conflicting ideas in your head, like it's best to just say, okay, what do I have control over? What do I do when this happens? You know, just game theory it out in terms of what are my mechanics, and then hopefully your inner psychology and your behavior and all the frustrations, you can just kind of, I mean, they're not going to go away, but they can be mitigated by the fact that you say, okay, well, I'm just going by the numbers. And when you just go by the numbers, you can at least take one level, one step of emotion out of all this stuff. Because, I mean, come on, it's like, you know, you save up money to like do this thing, and it doesn't work out. You're like, oh my God, how, you know, all this regret. I mean, in any case, yeah, the whole thing with stocks going higher, with inflation data cooling, is kind of like, well, what, you think that the Fed is gonna start quantitative easing again? Like, is that what you think it is? Do you think that they're not gonna raise interest rates in the future? Like, I don't know. It's just interesting. I look at this stuff and it's literally, I'm only saying this because the position's going against me. But yeah, I think it's fascinating. Like, why are people like gung ho, and why do they want to? Why do they just can't? Why can they not? Why can't they stop buying them? Is my question. I don't know. A discussion for another day. In any case, I'm gonna keep this short. I don't know how long it's been, but 8 minutes. Okay. Let me try to wrap this up in 7 minutes. So right now we're like at 75.50, right? This is also the back month, right? So this is CLU3, whereas the current month is CLQ3, and so it's trading at like 75.65, whereas we're kind of a little south of 75.50. So when you look at the deltas, that's your probability that it's going to expire at a certain number, right? So our number is 78.50. So right now the deltas, the option prices are just telling us, and the models that are behind them are telling us that however many days until expiration, the probability that it's gonna expire at 78.50 is about 36%. I'll take that bet. I'll take those odds, right? Like that's okay. And where is our point of pain on the downside is what was it, like 66.50, right? What's the probability that it's gonna be below 66.50? About 12%. Okay, so that's how we want to think about the numbers behind what we think is going to happen. We don't know what's going to happen, but these are the most likely outcomes. When we get to 78.50, the way that we adjust it, and this is going into finally a little bit more of the details behind the strategy. We're going like couple of levels deeper. Is we want to look at twice the amount twice the difference between where our strike price is and where our, like, I don't know, break-even range level, or at the very least the place we want to adjust it is, right? So 78.50, that's our number. We go up, right? So what, like 84.50? This is our point where we can't defend anymore against. All right. So the idea is that once we get to 78.50, the probability that it's going to trade above or below 78.50, which is the same thing as the probability of whether or not we're going to be profitable or unprofitable, is going to be 50%. 50-50 odds are not good, especially when the other side means unlimited losses. So when we get to 78.50, we have to adjust. I hope we don't get there, but if we do, what we do is we put on the 84.50 straddle. And if you're watching this, you probably have a pretty decent idea of how all these mechanics work and everything. And I do want to like build up to all of this and like my own take and my own theories behind why I think this stuff all works. But I mean, I'm doing it in real time to show that it does. I mean, maybe I'm wrong. And if I'm wrong, then, you know, you'll get to see it every day. But the idea is that, okay, normally, and, you know, we're using the platform, right? Like the way that the Tasty people say, what you should do is you should sell 2 junky out of the money calls and puts, right? And then let them expire. And when something is in the money, right? Like we are you get this ITM, right? That means danger. It means that your position screwed up. I kind of like having that. They should all have one strike in the money, because whatever your position is has more of that embedded intrinsic value, so that when you get the move, you actually get some of those deltas. In any case, let me find my train of thought again. So, okay, selling that 2 out of the money options on either side. What I am kind of advocating for is doing the opposite, right? Because what you're doing is you're saying, okay, the price is here, it's going to stay in between those things. That's the assumption that you're making. And if it gets to this point, then you can't really defend against it. You can defend against it, but you have to keep rolling. It takes a lot longer. What I'm saying is start in the middle. If it goes up, good. Now we can put on a strangle. We'll put on actually 2 strangles by putting a straddle on at the money. When it goes past our break even, we put another straddle on the other side. And what it does is it turns our straddle into 2 strangles. So that's how you maintain that same range of profitability while evening out your delta risk. Obviously, if you sell something at the money, it goes up. If it comes down, great, no problem. But when you're selling a straddle at the money and it goes past your break even, you're pretty much assuming, okay, the fact that it's going to go back there is too risky for me to bet, unlimited losses on. So where it is right now, wherever it is what the market says is efficient. It doesn't remember the fact that you sold it down there, so therefore it's going to go down there. Every tick, that whole like central limit theorem thing, and this animation that I'm going to hopefully put out soon, means that every tick, that's the new center. All right, so there's no memory of what happened in the past. So essentially what you're doing is you're selling, you already have an out of the money, whatever it is, put in this case, an in the money call. So you're selling an out of the money call and selling an in the money put. on the other side. And what it is it's a normal strangle and an inverted strangle. Because when you sell two inverted or in the money calls and puts, it's the same thing. Now, it gets a little tricky because now these in the money like strikes have a lot of embedded intrinsic value in them. And so they have like different trading mechanisms or patterns, and more like volume patterns around them. I mean, you'll notice here, like this is a pretty tight market, right? This is the out of the money put, right? So 174. I mean, I guess it'll tighten up, but like you can see that this is 3 cents, 4 cents, not bad. I mean, but as you go further out, you'll see like, okay, we're going from like 7 cents apart versus like 1 cent. And so to answer someone else's question, I believe it was Nick, who yesterday went back to the whole argument I was making yesterday about portfolio diversification and how you really want to what you're looking for is you're looking for natural hedges. And the best hedge that you have is like the opposite of your actual position, right? So, instead of being like, all right, well, I'm gonna be an ES and NQ, they're naturally correlated. So how is that diversified? Like the ES itself is completely diversified. It's got all of the stocks in them, all of the best performing stocks. They rotate them out every quarter. I mean, that's about as diversified as you can get. So if you have opposing positions on that can account for all of your delta risk, then that's pretty diversified in my opinion. In any case, the question that Nick raised was, why don't you just trade like a smaller product and trade like a couple more of them? The reason why is this. Like, so let's look at I actually haven't done it yet because I wanted to wait for the markets to actually open to see. All right, so what's the at the money like volume? Kind of around the 300-400, 300-500 like number, right? And let's see what MCL is. What was it? August? Yeah. You've got like 1, 2, right? So that's the reason why. It's just that this bid and ask, they're pretty wide. The market's pretty wide, and the thing is this: that's at the money, right? So what did we say? We wanted to trade like the 84.50. Good luck. I mean, there's like nothing there. All right, and so 13.42. Oh no, hold on, 42.45. Hey, I'm not gonna lie, it's not terrible. We can look at it. I'm gonna stick with what works for me right now, but we can try. The reason why I made this rule for myself, which could be obsolete, but the reason why was because I was trading MNQ with this strategy several years ago, and they just didn't have strikes up at the level where I wanted to sell something, and so I'm not crazy about it. I like having a very simple, streamlined position that is clean. So just doing one, I guess I can split it up. I don't know. Doesn't look bad, but come on, just the fact that like you have like 2 in open interest, like in the single digits all the way up the option chain. I don't know. It just doesn't really strike or inspire that much confidence in it in terms of how liquid they are and how easily you'll be able to get a fill and how easily you'll be able to get out of these positions. So I'm sticking with the mini product for now. If we build things up, we might be able to split them between like maybe 2-3 products. We'll see what happens. I like that I'm doing one thing just because it simplifies it for me and also for you if you want to like follow along and see the thinking behind why I'm doing things. But I think that more or less covers the basics that I wanted to talk about in terms of what the probabilities are, what numbers we're looking at, how what's the probability that those numbers will expire in the money, and why we're adjusting where they are. Kind of going into how we're adjusting and the all-encompassing kind of strategy behind Hur Fund, and also this concept of liquidity in different products and everything. So I think I'm going to leave it there. Hopefully that all makes sense. If you want to contact me, you can email me, arthur@arthurhur.com, or better yet, just comment below, and everyone will be able to see it, and I will definitely respond to you today, or before the next broadcast. And if I don't, then I'll address it on the actual broadcast, because I definitely will see it. Thanks. I'll see you tomorrow. Bye.